Hello, and welcome back to the Human Observation Lab. I'm New York, your host and observer of the fascinating structures behind human behavior. Today, we're going to examine something that has dominated the news recently: financial market turmoil.
Hi everyone, I'm Juan. Yeah, I've been seeing a lot of scary headlines lately. Financial stocks falling, some bankruptcy. Honestly, it makes me nervous even though I don't fully understand what's happening.
That reaction itself is precisely what we'll be analyzing today. The nervousness you feel, Juan, is not just a personal response, it's part of a larger psychological phenomenon that drives entire markets. Let me ask you, when you see headlines about financial instability, what's your first instinct?
I guess my first thought is, should I be worried about my money? Or is something bad about to happen? It's like, I want to do something, but I'm not sure what.
Exactly. That urge to act, combined with uncertainty, is the seed of what we call financial contagion. Today, we'll use the recent news about falling financial stocks, the MFS bankruptcy aftermath, and even a cryptocurrency controversy to understand why humans react the way we do when money is at stake. Let's begin our observation. Let's start with the facts. Recently, Japanese financial stocks experienced significant declines. The CEO of Apollo, a major investment firm, was reportedly struggling to contain the fallout from the MFS bankruptcy. The effects have not subsided easily.
Wait, so one company's bankruptcy caused other financial companies' stocks to fall? That seems unfair? Like, why should company A suffer because company B made mistakes?
An excellent question. What you're describing is called contagion effect in behavioral economics. It's not about fairness, it's about how human minds process uncertainty and risk. When one institution fails, people instinctively question, could others fail too?
I see. So it's like when you hear about one person getting food poisoning at a restaurant and suddenly you don't want to eat at any restaurant?
That's a perfect analogy. In psychology, we call this availability heuristic, when people judge the probability of events based on how easily examples come to mind. A recent bankruptcy makes the concept of financial failure highly available in our minds, so we overestimate the risk.
Okay, so our brains are kind of shortcutting, but that doesn't seem entirely wrong. It's being cautious, right?
From an evolutionary perspective, you're correct. This mental shortcut helped our ancestors survive. If one member of your tribe got sick from eating certain berries, avoiding all similar berries was a smart survival strategy. But in modern financial markets, this same instinct can cause unnecessary panic that becomes a self-fulfilling prophecy.
A self-fulfilling prophecy? What do you mean by that?
When people believe financial institutions are in trouble, they withdraw investments. This mass withdrawal then causes the very trouble they feared. It's called a bank run or, in broader terms, reflexivity, a concept popularized by investor George Soros.
Oh wow, so the panic itself creates the problem? That's like a vicious cycle.
Precisely. Now, let's layer another psychological factor: loss aversion. Research by psychologists Daniel Kahneman and Amos Tversky showed that humans feel losses about twice as intensely as equivalent gains. Losing 10,000 yen feels much worse than gaining 10,000 yen feels good.
That's so true. Losing money feels terrible, but gaining the same amount just feels nice, I guess, not as intense.
This asymmetry in our emotional response explains why sell-offs happen so quickly in markets. The fear of loss is psychologically more powerful than the hope of gain. When negative news appears, this loss aversion combines with availability heuristic to trigger rapid, often irrational, collective behavior.
So when the news about MFS bankruptcy came out, people's brains went into overdrive. I might lose money, I need to act now, and everyone selling made things worse?
You've grasped the structure perfectly. And this brings us to an important observation. The Apollo CEO's attempts at firefighting, trying to calm markets, face an uphill battle against these deep psychological forces. Rational statements often fail to override emotional responses.
That makes me wonder, Can anything actually stop this panic once it starts?
Let's examine another piece of news. Japan's Chief Cabinet Secretary Kihara stated that there are large fluctuations in financial markets and that they are watching with extremely high tension. He emphasized the government's vigilance.
Statements like that always appear in the news during crises. But honestly, does saying we're watching carefully actually help anything?
That's a perceptive question. From a psychological perspective, such statements serve a specific function. They're not meant to change economic fundamentals, they're designed to provide what we call psychological anchoring.
Psychological anchoring? Like giving people something stable to hold on to?
Exactly. In times of uncertainty, humans experience what psychologists call cognitive turbulence, a state where our usual mental frameworks for understanding the world become unreliable. We desperately seek stability. Authority figures providing calm, measured statements act as anchors in this turbulence.
Like how kids feel better when an adult says it's going to be okay, even if nothing has actually changed yet.
Another excellent analogy. However, there's a critical limitation. The effectiveness depends entirely on source credibility. If people trust the authority figure, the statement calms them. If trust is low, the same statement might actually increase suspicion.
That makes sense. If someone I don't trust says, "Don't worry," I'd probably worry more, you know?
This brings us to an interesting paradox of modern society. We have more information, more official statements, more data than ever before. Yet trust in institutions has been declining globally for decades. The very tools we use to calm markets may be losing their effectiveness.
That's kind of scary. If people don't trust anything, then panic becomes harder to stop?
Indeed. And this connects to another phenomenon we observe, herding behavior. When official sources lose credibility, people turn to alternative sources, social media, influencers, or simply following what others are doing. If everyone is selling, maybe I should too.
I've definitely felt that before. When I see a lot of people doing something, I feel like I'm missing out if I don't do it too. Is that the same thing?
Yes, that's FOMO, fear of missing out, which is related to herding. In financial contexts, it works both ways, herding into investments during bubbles, and herding out during crashes. Both are driven by the same psychological need to align with the group when individual judgment feels uncertain.
So our brains are wired to follow the crowd when we're unsure. But that can lead us off a cliff sometimes?
A harsh but accurate assessment. Now, let's examine a modern twist on these age-old psychological patterns, the case of the Sanae Token and cryptocurrency regulation. Finance Minister Katayama recently stated that authorities would respond appropriately regarding the Sanae Token cryptocurrency. This case offers us a fascinating window into how trust and psychology operate in the digital age.
I saw something about that. It was named after a politician or something. That seems really weird. Why would anyone create a cryptocurrency based on a person?
This touches on what we might call identity-based speculation. In traditional markets, investments are supposedly based on fundamentals, company earnings, economic data, and so on. But in the cryptocurrency world, we see a different psychological pattern, investment based on narrative and identity.
Narrative? You mean like stories? People invest because of stories?
Precisely. Nobel laureate Robert Shiller wrote an entire book called Narrative Economics about this. He argues that economic events are often driven by the spread of popular stories, narratives that capture our imagination and emotions, regardless of factual accuracy.
So like, if there's an exciting story about something, people want to be part of it, even if it doesn't make logical sense?
Correct. A token named after a political figure creates a narrative. People might think, this person is influential, so this token might become valuable. It's a form of symbolic association, transferring the perceived qualities of a person to an unrelated asset.
But that's not how value actually works, right? Like, a token doesn't become valuable just because it has someone's name?
You're thinking rationally, which is excellent. But here's where psychology diverges from rationality. In the short term, perception can create value. If enough people believe something has value and act on that belief, it becomes a self-reinforcing cycle, at least temporarily.
Wait, so belief creates reality? That sounds almost magical.
It's not magic, it's social psychology. This is what economists call the greater fool theory. You might buy an overvalued asset believing you can sell it to someone else at a higher price. As long as new believers enter the market, prices can rise regardless of fundamentals.
But eventually, someone is left holding the bag, right? The last person who can't find anyone to sell to?
Exactly. This is why regulators like Minister Katayama feel the need to respond appropriately. The psychological mechanisms we've discussed, loss aversion, herding, narrative-driven behavior, can create bubbles that eventually burst, causing real harm to ordinary people.
It's kind of sad, actually. People get caught up in excitement and stories and then lose money.
Now let's step back and consider what all this means. We've examined traditional financial panic, government response, and the new frontier of cryptocurrency. What patterns emerge?
Feels like our brains are kind of working against us. Like all these instincts that might have helped our ancestors are causing problems in modern finance.
That's a profound insight. The psychological mechanisms we've discussed, availability heuristic, loss aversion, herding, narrative-driven behavior, are not flaws per se. They're features that evolved for different environments. The challenge is that modern financial systems operate at speeds and scales our brains weren't designed for.
So what can we do? Are we just helpless against our own psychology?
Not at all. The first step is awareness, and that's exactly what we do here at the Human Observation Lab. By understanding these structures, we can recognize when our instincts are leading us astray. We can pause, question our reactions, and make more deliberate choices.
So like, when I feel panic about financial news, I can tell myself, wait, is this my brain shortcutting? Should I think more carefully?
Precisely. And at a societal level, understanding these mechanisms can help design better systems, regulations that account for human psychology, communication strategies that genuinely reassure, and educational approaches that build resilience against manipulation.
That gives me hope. It's like, we're not perfect, but we can understand ourselves better and make smarter choices.